Welcome to Investors Insights. Our topic today is don't hold your breath. We're going to be talking today about the breadth of the market, as well as from the standpoint savers and spenders, historical data, interest rates. We've got a lot of topics to talk about, but several of you have been calling in saying, boy, this market is showing a lot of strength, a lot of breadth to it. So with that, we're going to go around the horn here and talk. Everybody's brought some incredible research. I'm joined by my distinguished colleagues, as I like to refer to them, Bobby Norman, Trey Booth, and Ty Miller. Guys, really had fun this morning in our meeting. Enjoyed all the data that you put together over the weekend. So thank you. Bobby, you want to start us off because I thought you had some great comparisons that we needed to look at.
Yeah, we continue to get questions and comments from clients who are kind of surprised at how well the market has performed this year and are asking if it can continue, considering that at the beginning of the year, there were some economists expecting the economy to be in a recession by this point. So one of the measures we utilize to quantify and compare market breadth and underlying strength of the market is by looking at the percentage of stocks trading above their longer term, what we call the 200-day technical moving average. So as a general rule, if a stock is trading above its 200-day moving average, it is considered to be in an uptrend, and vice versa if price is below the 200-day moving average. Furthermore, the higher the percentage of stocks above their 200-day moving average implies buying pressure and market strength, which is more widespread, suggesting the market's advance is likely to sustain itself. So as you can see in this chart, on the far right side, currently 73% of stocks in the S&P 500 are trading above their 200-day moving average seen in the blue column. This compares to only 48% at the end of 2022 seen in the orange column on the far right side of the chart. But looking at the chart, current percentages are shown in the blue column versus where stocks were back at the beginning of the year in the orange columns. Obviously, the blue columns are a lot higher. That's great. As you can see, the composition of breadth and underlying strength and leadership has turned increasingly bullish as the highest sector readings are seen in technology, industrials, energy, and consumer discretionary sectors that we've liked this year. And we use this specific chart and information in our day-to-day management of client portfolios. And this strength across the market is due to a resilient economy and then also a receding inflation pressure that we saw last week. And then also the Federal Reserve at the end of its campaign to raise rates. So again, we're seeing a notable expansion in the market breadth of the market, and that's a good sign.
Yeah, and Bobby, let me say this. Over the weekend, I got a lot of compliments from clients who were just talking about how we kept them up to date about the strength in relation to all the discussion about possible recession. And they also not only appreciate the vlogs, but what we're doing on social media in terms of LinkedIn, Twitter, Facebook, YouTube, our podcast. But this has been the big question for this year of 2023. And I thought that was a great comparison that you used here today. The other thing that I'm hearing from, and you gentlemen have talked about as well, is about interest rates, not only in terms of mortgages, but also in terms of money markets and CDs. We're trying to keep our clients fully aware of what we're doing here at Five Plan Partners in those areas as well. And Trey, you really, with your research today, hit home, pun intended, I might add, in regards to spenders and savers and people buying houses and people saving money. So elaborate on that and please share your chart with them as well.
Absolutely. Thanks, Rick. So as anticipated, the Federal Reserve raised interest rates last week. So the top end of the Fed funds rate's now up to 5.5%. Now that's a double-edged sword situation of higher interest rates. And I'll start with the good news. So you can get north of 5% by just sitting on money market, which is something we enjoy providing to clients right now. And you can get excess of that if you're willing to take on a little more risk in corporate bonds. So, but there's the other side of that coin, and that is the cost to spenders. This chart shows that you see 30-year mortgage rate, credit card interest rates, and car loan interest rates from 1995 really till the last year have just consistently come down. And that has been a boon to spenders. but we've seen a sharp spike up. You can kind of see that hockey stick really quick spike up where the cost of borrowing has really harmed spenders. There's no free lunch. Savers are definitely getting more on their money. That money's coming from somewhere. This is an altruistic scenario. That money's coming from the spenders who now are paying higher interest rates. And so it's a delicate balance the Fed's going to is walking to. At what point do we benefit the spenders too much at the expense of the spenders, to where we see the economy kind of dip into a recession where spenders can no longer sustain these rates. Right now, market participants anticipate at least one more Fed rate hike going forward, but then that should be about it. So from here on out, we expect kind of interest rates to rise slightly, but we'll see where this delicate balancing act kind of comes out.
Yeah, as you talked about all that in the meetings we've had over the past weeks, I got to reminiscing with some of our clients, especially the younger ones who have said, "Oh my word, do you know what they want for a mortgage rate nowadays?" And our first house, Peggy and I got at 10.75%. So I know we talk about rates being higher, and it's all relative, but in relation to historical, there's still some good rates out there. The other thing in the discussions that I think we've all enjoyed is when clients are telling us that they still have, they've got money at a certain institution, only to find out that we've got rates that are far more attractive. And I appreciate you bringing that up, and love to have a conversation with any of our clients in regards to that as we coordinate with their financial blueprints in relation to savings and also portfolios. So, and then Ty, you really stirred me up in this morning's meeting as you started doing historical data and talking about markets and bringing up some of the years that I've been through with some volatility. And I think it's good for us to realize where we've come from in this economy and the markets. So elaborate on that, please, sir.
Yeah, so you guys may have seen on the news, the Dow Jones Industrial Average. It's the oldest kind of indice that we follow here in the U.S., was up for 13 consecutive days. And so that is tied for the second longest streak ever. The only time it was longer was 1897. And at that point, the Dow was started at 39 and ended at 43. Whereas, this time we started at about a little over 33,000 and ended up a little bit over 35,000. Now that streak since ended, but some interesting points, as you can see in this chart here, are, tied for the second longest, as I mentioned. The other year that was tied for the second longest with 13 consecutive days was 1987, from January 2nd to January 20th of 1987. Of course, most people will remember that in October of 1987, while this was a great run, October was pretty ugly there. And Greg, you mentioned that, you were in the industry at that time, sitting there watching it.
Yeah, remember January extremely well. And also remember that on July 4th of 1987, Peggy and I bought our first house, 10 3/4 mortgage, and moved in. And we were just thrilled because rates had come down. And then October 19th of 87, we had the stock market crash. And I will never forget that day, professionally and personally. And here we are today. So, it's great to reminisce. It's also great to, look at historical data.
Yeah. And I guess just some high level points I want to hit on real quick. As you can see in this chart, again, 13 consecutive days, great run. However, the Dow was only up, 5.3% in that time frame. That's pretty muted compared to what it normally is when you have a run like this. And then I also want to, kind of reiterate the point that the Dow Industrial Average is only 30 select stocks that are publicly traded. So it's not a reflection of the total economy. Between the New York Stock Exchange and the NASDAQ, there's over 5,000 combined stocks. So 30, select ones are pretty, minimal, reflection of the economy overall. So don't take this, too much, into consideration, but it is interesting. It is historical. And then, with these big numbers, I think, you can get caught up in, it moved up, 200 points this day or 200 points that day. But just remember that with the bigger the numbers, we have the average return, the total return in a percentage. And that's what, is important to focus on.
That's all great information. And I think we need to keep that in mind, especially with the Dow only being 30 stocks, and great points there, Ty. like I said, you guys did an excellent job in the meeting today and the data that you provided. We hope this vlog has been well worth your time. We hope it also emphasizes the amount of research that we do here at Five Plan Partners. We are always looking at the positives as well as what could possibly upset things. Also know that in looking at this data, we are using it in relation to your financial blueprint and also your portfolio strategies as we navigate through all of this. It's hard to believe, but this is the last vlog of July 2023. In 5 months, we will enter 2024. A lot's going on. The information's coming at us, and we're going to see to it that we continue to provide you the information, the knowledge that gives you confidence to know what's going on each and every day. And so you don't have to get into the emotional drama of some of the media and other comments being made out there. We hope you have a great week. We thank you for believing in us and know each and every day we're striving for our clients, for you to have a better, richer, fuller life. Thank you.